We don't have the Mr. Zemanidis. Unfortunately, he will not be with us. So we are going to the next panel, which is the new inflation era and how to address it. And with us is Mrs. Wendy Edelberg, Director of the Hamilton Project and Senior Fellow, Economic Studies, the Brookings Institute. Hello, Mrs. Edelberg from Athens, Greece. How are you?
I'm very well. Hello.
Great. It's good to, first of all, thank you very much for being with us. And you may proceed with a 6 minutes introduction about the topic, and then I'll have some questions for you. So please go ahead.
That's wonderful. Thank you very much for having me here. So first, let me say a little sheepishly that my comments will be narrowly about the United States. Because that is where I am more of an authority. So the question I want to answer is, how big of a problem is it that the pace of US economic growth is slowing? And will that slowing solve our inflation problem? Certainly one factor behind the recent run-up in inflation in the United States. So for example, in the US, core consumer prices from July to October climbed 5% at an annual rate. One factor was the rapid economic growth in the United States since the first half of 2020. So does that mean slowing is a good thing? Yes, as long as it is a modest slowing that helps bring inflation back down towards the Federal Reserve's 2% target. Basically, demand in our economy has been growing faster than the capacity of the economy to supply goods and services. The fast pace of economic growth has meant that the economy is strained beyond its sustainable level. A slowdown is essential. Indeed, to my mind, economic growth in the US has been too strong even in recent months. Real consumer spending in the US grew at a very strong 4.8% in the 3 months through October. Even more concerning, that was led by strong spending on goods. Goods spending in the United States continues to be much stronger than trend and much stronger than the United States can sustainably supply. However, tightening monetary policy should help to slow aggregate demand in coming quarters. For example, manufacturing in the US looks on track to slow. Aggregate measures such as the quarterly change in GDP may show the economy growing slightly, moving sideways, or even contracting modestly for a few quarters. If a contraction leads to slack in the economy, and it is determined we are in a mild recession, businesses would be saddled with idle capacity and the unemployment rate will likely rise. I will note that the unemployment rate might rise from today's very low level, even if we aren't in a recession, if more people enter the labor force and start looking for a job, and that would be very good news in the US. Different sectors of the economy will no doubt experience these changes differently. As the economy rebalances, some sectors, namely leisure and hospitality, will likely see increased consumer demand and have increased labor supply. At the same time, a contraction in some sectors means workers and firms in some of those sectors will feel the slowdown acutely. For example, alongside the extraordinary demand for consumer goods, employment in transportation and warehousing has been above trend for some time. However, in recent months, employment in this sector, as well as in retail trade, has outright fallen. These gyrations will mean that some people in the United States will experience significant economic changes, regardless of whether the economy expands or contracts modestly. But the benefits in the United States will be widespread if economic growth slows, the level of potential catches up with actual output, and inflation comes down to more acceptable levels. That hoped-for outcome is the proverbial soft landing. In this regard, news of slowing in labor markets and consumer spending is good news. Then, why are people so worried with regards to the economy? Acknowledging that slowing is in and of itself anxiety-inducing, there are reasons to fear a more painful economic contraction is on the horizon. The outcome to worry about is a weak economy alongside little relief in inflation, even in sectors where the slowing is concentrated. My concern is that if inflation doesn't come down to a more reasonable level with a moderate slowdown in economic activity, the U.S. economy might be headed towards a more painful contraction. I do not see this yet, mainly because spending and employment are still quite strong. But a hard landing could happen for at least two reasons. First, higher inflation expectations could get built into pricing behavior and lead to unacceptably high inflation. That would suggest that firms and workers had lost confidence in the Fed's inflation-fighting credibility. And thus, they had built expectations of higher inflation into their pricing strategy, into rents, and into wage demands. Second, continued supply shocks, additional problems in the supply of energy, perhaps, could send prices ever higher. So could a worsening in the U.S. of labor force participation. The Fed should be worried in that case that supply shocks would raise inflation expectations, affecting the economy even after those shocks have abated. Moreover, and more problematically, such persistent supply shocks would suggest the economy's potential to grow was lower than the Fed had anticipated, which would call for further restraint on demand. In the case of those worrying outcomes, the Fed would likely raise interest rates to lower economic output, not just back to where they estimate it is currently sustainable, but actually below that level. In that case, if the Fed was only worried about inflation expectations, they would simply be doing that to bring expectations down. However, in the case of ever worsening supply shocks, the Fed would also readjust lower its estimate of the U.S. sustainable level of output. My concern about these outcomes grew smaller with the recent economic releases. Overall, I see both too strong economic activity and too strong inflation. But the good news is, I think it's the strong economic activity that is one of the biggest factors keeping inflation high. This means the Fed has more to do. And even better news is that core goods outright fell in October. Prices of core goods outright fell in October, even though demand for goods has remained stubbornly resilient. And some industry data in the US shows that rents of housing are falling. One more worry to put on the list. Monetary policymakers are trying to hit a moving target, assessing how fast to remove stimulus that monetary policy has been providing to the economy since 2020. Even though the stance of policy is still not very tight by my estimation, the act of removing stimulus has to be calibrated to avoid an unnecessarily painful recession. We don't want the recession to be larger than is needed to bring the inflation rate just back to target. That is all to say, for the next few quarters, continued slowing in the pace of output and some cooling off in the US labor market would generally be good news, as long as it coincides with a softening of inflation. And I'm delighted to take any questions you have.
Thank you very much for your presentation here regarding the inflation. I have just a few questions. The Federal Bank and the European Central Bank are applying, after some significant delay, a drastic program of raising the interest rates. So far, though, the inflation is not retreated enough. What would possibly be the next moves if inflation continues to be on those levels?
So, absolutely. I mean, the issue in Europe is more complicated in a sense than in the United States, because Europe is experiencing easily identifiable energy shocks that should not be persistent. And so the Central Bank of Europe has to figure out how much they can smooth through, how much they can look through that shock, how persistent that shock can be without driving up inflation expectations. This is, of course, why keeping low and stable inflation expectations is so critical to functioning monetary policy, because the more stable inflation expectations are, the more monetary policymakers can look through even persistent supply shocks like what Europe is experiencing. In the United States, the issue is more straightforward. Our energy prices are high, but they're not having extremely large effects on core prices. And so in the United States, I think as long as inflation looks like it's not significantly coming down, the US Fed, the US Central Bank, is going to have to keep raising rates. I think it's appropriate that monetary policy increases are beginning to slow in the US, and it wouldn't surprise me if come, let's say, January or February, they're able to pause and take stock. But they're going to need significantly positive news on the inflation front in a published release before they pause.
And one last question is, does labor supply and demand in the services sector, as well as the recent increases in housing prices, present risk to the inflation outlook?
Oh, absolutely. What's happening with housing in the United States is complicated because what we see in the published numbers has a very significant lag to what is happening in real time, particularly with regards to rental units. So the price indices that are published for the cost of shelter in the United States very appropriately reflect the average price that any given person is paying for their rent. So that includes some portion of people who are having to get new leases, and probably these days are seeing a significant jump in the rent on their units if they have to roll over to a new lease. But the vast majority of rents that are captured in the actual published index is everybody who hasn't had to roll over their rents, everybody who hasn't had to roll over their leases. So the increase in rental prices in the published index has a very long lag as people roll over into new leases and see big jumps. The good news is that the prices on new leases seems to be coming down, but it's very difficult to know how much that is actually going to show up in the published index. The Federal Reserve clearly knows this. They knew this on the way up, and we all expected the published index to rise quite rapidly as leases rolled over. And now we're expecting the published index to fall as leases roll over. But it is far too soon to put those declines in the bank. And so it is very uncertain what's happening to shelter prices. This is not usually what we worry about, but this has been such a very dramatic cycle with a very sharp increase, and now what appears to be a relatively sharp decrease. And so I think the Fed needs to be patient.
Well,
Did you also ask about labor supply?
Sorry?
I think you also asked about the labor market. Did I remember that? Yes. So what's happening in the labor market is immensely frustrating in the United States. Labor force participation among prime age workers, mostly women, but even to some degree men, is basically back to where it was pre-pandemic. But labor force participation of people who are over the age of 55 is sharply lower, and it doesn't seem to be coming back. And the result, mostly from that decline in labor force participation, is that we are maybe as high as 2 million workers fewer than I would have expected given pre-pandemic trends. Basically, we just have a smaller labor market than we were on track to have before the pandemic. And what that means is that we need to have a smaller economy. I think one of the main factors that's been pushing up inflation is that consumer demand is completely back to pre-pandemic trends and way more focused on goods, but in aggregate, back to pre-pandemic trends, but our labor market isn't. So basically, we want to spend like there's been no pandemic, but we can't supply like there's been no pandemic. And that is the tension that is fundamentally causing inflation in the United States.
Well, Ms. Edelberg, thank you very much for this very enlightening conversation about inflation. We really appreciate you are with us at the Greek Economic Summit, and we look forward, of course, to see you in person sometime, in Greece. Thank you again, and have a good rest of the day.
Hello.